FOMC meeting and also its impact in the markets. I'm sure you understood a couple of the things. Fed. It's been talked over last week and this week. The markets priced it in. But yet, after the announcement at 2:15 p.m., we saw the markets declining. What do you think about that?
It's hard to know why that happened. I think you're right that what the Fed did was pretty much priced. The Fed did issue a pretty downbeat statement to go along with the actions they took. They clearly have toned down what probably already was a subdued outlook, and they said that they saw downside risk, so the asymmetric kind of risk to the downside.
So that's the difference between the two FOMC statements?
Definitely.
The downside risk is more negative?
Yes.
How so?
Lower outlook and downside emphasizing downside risk to a lower outlook, I think, is what was new in the statement.
That's the new thing. And let's talk about the Operation Twist. They decided on Operation Twist, and it's $400 billion. Is it sufficient enough for the markets?
I think that it was in the ballpark for what markets expected the Fed to do, and it's a sizable adjustment in the portfolio. I don't think anybody has any illusions that an operation like this is going to have major impacts on the yield curve. We have actually seen the yields move down tremendously across the board in the last, say, 6 weeks or so as investors have gotten scared about the outlook and there's a lot more uncertainty, and treasuries have benefited tremendously from that. So to my way of thinking, the Fed's mostly trying to lock in some of those declines in the event that the economy performs a little better and people get a little less scared. You'd expect Treasury yields to sell off in that environment, and hopefully that what the Fed is doing will limit some of those losses down the road and keep rates at quite low levels. So
are you saying that twisting the long-term rates, that yield curve, is not going to help us see any relief in the refinancing of the mortgages and in terms of attractive long-term rates?
I just think that the decline in yields has been so tremendous over the last month and a half that it kind of swamps whatever the Fed is doing in the margin. That's somehow been discounted, but I think it's gone way beyond anything that the Fed directly did because it's reflecting broader expectations about high risk of recession, a lot of uncertainty, capital flowing out of the European sovereign market into treasuries because of fears about that market. Certainly at the margin, having lower interest rates, and these are significantly lower rates and breathtakingly low levels, is helpful, but activity is depressed. We aren't seeing much impact in terms of refinancing activity or home sales or anything else. And I'm not sure we are going to right now because the economy is struggling to grow. And in that environment, that's not the only thing going on is that the Fed's lowering rates or that market rates are coming down. So
you said what's next for the interest rate. What's next for the equity markets? I see sometimes that your research, you're bullish, sometimes you're bearish. Where are you right now in terms of the year end?
I think the firm is still maintaining, our equity strategists are still maintaining a pretty high target for the S&P at the end of the year. I assume that target is vulnerable to being moved down, maybe substantially.
What is the target?
I believe I'm correct that it's 1450, 1475 on the S&P. I believe I'm correct about that. And so we're a long ways from there. A lot of things I think it's safe to say would have to go right to achieve that. But, and I think our economic forecast has been marked down a lot recently and would be a challenge to get to that level, but not impossible.
You said it about the U.S. economy. It's definitely, the outlook is negative, really, in actual terms, too. Do you think we're walking down towards a recession?
Not quite thinking that is the most likely outcome, but it's very plausible.
But taking IMF's yesterday report with the growth going down to 1.5% for the year end of 2011 from 2.5%, what do you think about these growth rates and the jobs numbers?
I'm not sure exactly what the IMF is predicting, from here on, but I can tell you what we have, which is we have growth at kind of 1, and that's very weak. And we're very vulnerable to any kind of shock that might come along that could push you into contraction. And it's also possible that we're misjudging the underlying dynamics, that we're assuming that we've based at 1%. That's not certain either. And in particular there, I think we need to watch what happens with the labor market to be sure that we are remaining in a position where employment growth is weak, but it's positive. If the next employment report were to show that payrolls are contracting, then I think we'd start to question whether we've based out at 1, or we perhaps the downward momentum of the economy is not fully realized yet. So that's the first issue, is just to see, are we in fact stabilizing at this low positive growth rate? And then where we go from there. Then I think these various event risk come into play. The principal one is from the sovereign debt crisis in Europe.
Right.
But there's a sleeper which will surface in weeks, probably in the United States, which is this congressional supercommittee is facing a November 23rd deadline, I believe, to come up with a game plan for $1.5 trillion in deficit reduction over the long haul. If they can't come to any agreement, then we'll move to a position where we'll get some sort of across-the-board cuts that will be implemented over time. My guess would be that the markets are going to start to focus pretty intently on this issue, certainly by early November, since that deadline is looming. So you could end up in a situation where you have either competition for concern between Europe and the United States like we had in late July, early August, or it could be that the European situation settles down for a little while if Greece gets funded and the focus shifts back to the United States. But either way, there's a lot to digest, in the coming weeks before we can have much conviction about the outlook.
Interesting. Earlier you mentioned about the two sectors, jobs and also the housing sector affecting the economy. And those are the two bleeding, unfortunately, problems in the U.S. economy. Those are the crises, actually, two crisis sectors. And looking at this last week's two data that came in terms of the housing sector, they are contradicting to each other. The housing starts increased, and yet the index showed negativity. How should we read it?
You mean the home sales went up? Home sales went up in today's report, right? Those data are for August, and our thinking is that they may reflect the government's change in terms of the support for the jumbo market. They're lowering the qualified level on those mortgages, and buyers may be moving in to lock in a mortgage for a jumbo purchase before that change takes place. The more recent data that we watch week to week on mortgage purchase applications, which are well into September, have actually weakened to kind of new lows for the year, and are consistent with that kind of activity.
So they're consistent with the housing starts then, the mortgage applications?
They're just telling us that everything in housing, from sales to starts, I mean, in an underlying sense, looks very soft. And I think that the increase in sales, which was not all that dramatic and it's off a low level, should not give false hope.
I see.
Everything
Even
else,
the permits should not give us hope.
I don't think so. I think that in terms of the single-family market, there's just not much going on. The good news is you're not seeing contractions from these low levels, particularly.
At least.
So not hurting you that much.
Okay.
But there certainly doesn't seem to be much upward momentum, despite what you were emphasizing earlier, which are how low mortgage interest rates are.
So it cannot even go further down with what Bernanke is doing. You're saying that it's not going to really help much,
Seemingly,
which is the 61% of the economists surveyed today said that even if he does something, it's not going to help the economy. And you're on that side of the...
I think that I wouldn't want to say that I don't think the Fed's actions, and there'll be more of them in the coming weeks most likely, are not of any help. It's just that I think we need to understand that the Fed would like to be able to cut interest rates 100 basis points right now, and they probably like the latitude to do double that, and they don't have it. There's nothing I can think of that they could do in place of that that's feasible that would come close to matching that kind of a rate cut.
What can be done for Greece, by the way? You mentioned the European crisis before. With the CDS is between 98 and 99%. Do you think it's going to go default? Should it go default?
Again, it depends on what you mean by default. I think that, they're already, going through some sort of an attempt to restructure on a voluntary basis, whatever that means, Greece's debt with the private sector holders. Likely we're going to see some sort of revisiting of this to where ultimately Greece will see a much deeper restructuring of the debt because the debt ratio is so high and it's climbing rapidly as Greece continues to run pretty large deficits. How that process takes place and whether they'll be done in an environment in which they're getting support from the Eurozone creditors or not, or whether they might see their funding cut off, whether or not they stay in the Eurozone, I think those are almost imponderables at this point. But the risk of seeing Greece either get cut off from funding and causing some kind of major ripple effect, I think, has gone up in recent months, recent weeks, and as has the risk that Greece will leave the Eurozone altogether. Those are not our base case, but the risks of those kinds of outcomes are going up.
Which brings me to my last question. So Greece and the contagion factor in the European crisis, we saw Italy being downgraded by S&P recently. What is the impact of the European crisis if it happens again in the United States and the U.S. markets?
Depends on how it plays out. If best case, there be enough institutional support in place to limit ripple effects even through the European financial system and the real economy, much less the United States. Worst case, there's a very disruptive event there with major contagion to the other peripherals that causes a major credit event inside the Eurozone and causes a flight from risk assets across the world and hurts real economies everywhere. And there are an infinite number of scenarios in between those two. I think right now it's just really hard to know how it's going to play out. It's a very political process, and I think we're not very good, any of us as economists, anticipating what politicians are going to do. It's a pretty opaque process with a lot of important players involved, and you could have a breakdown on any number of fronts from the different political officials as well as at the ECB. I mean, everybody's got to play their part for this to work out in the least damaging way. And my strong impression is that we've been seeing a lot more stress across the board in the process recently. That stress has diminished somewhat in recent days, but it's not to say that we can maintain that posture for very long. Even if Greece gets the next tranche of funding, they're going to be up for review again in December.
I know I said that was my last question, but you said that there's some stress over there, and talking about not having any stress and recently being upgraded by the S&P Turkey. The Turkish market is like the star, even though it was upgraded in the local currencies.
Right.
What do you think about Turkey?
I think just in general, Turkey, as well as the other emerging economies, looks so much better by comparison to the U.S. and Western Europe. It's a view that's pretty easy to take in the sense that these are countries that for the most part, are unencumbered by the kind of structural problems that we are obsessed with in the U.S. and Europe. In most of these countries, you've seen a move toward somewhat independent central banks with inflation targets. They're running fiscal accounts that are very solid, in many cases current account balances.
That's right.
So there's a lot to like there. At the same time, I wouldn't want to get carried away with that story because I think that time has taught us that even in the new paradigm of modern emerging markets, that they certainly feel the ripple effects from a bad scenario or a bad economic outcome in the majors. That certainly happened in 2008. Despite all the optimism about decoupling at that time, they didn't decouple. Relative to their own potential growth rate, their recession was every bit as bad as it was in the U.S. and Europe. And the recovery has kind of followed in lockstep. Now you're seeing investors, I think, are much more nervous about the global backdrop. The flows into the emerging markets have diminished but not shut off, especially on the debt side. They're still attracting inflows. That's the same thing that was happening in 2008, and then they didn't. They suddenly shut off. Some emerging market central banks had to tighten to defend their currencies. And when the financial channel turned against them into outflows, along with a hit to merchandise trade and loss of confidence, as I said, their recessions, again, considering what their potential growth rates are, were pretty severe in most cases. So I think the jury's out about how this plays out, but our own view on the emerging markets is pretty cautious in the sense of they will grow considerably faster in the US than the U.S. and Europe, and in that sense look more dynamic. But against their own potential, we have them growing, subpar.
Thank you so much. I need to ask more questions about emerging markets in Turkey. I see that there's lots of ideas that's coming from there, which is interesting too. But thank you. Well put. It was a very, very nice interview. Thank you